Have you taken any deep dives in the commodity sector? When I say commodity sector, commodity stocks?
No, not at this point of time, because one, I think the global commodity cycle is slowing. A large part of it is obviously China, because China itself growth is slowing down and the commodity cycle is slowing down out there, and therefore we've actually have an underexposure to commodities. We've got an underexposure even to the metal sector to some extent.
How are dynamics of the insurance sector shaping up? Because there is a concern that the springtime for ULIP is now over.
Well, I think for policyholders or people who are buying into policies, I mean, the sector offers a complete range of products. So for those people who are looking at pure risk, I think we have the traditional products, and we've got extremely well-structured traditional products, especially in Birla Sun Life. And these traditional products, cover your risk, and they allow you to participate to some extent in, the market. Though, of course, the asset portfolio is a completely risk-free, safe portfolio invested mostly into government securities and AAA, but still give you some kind of a decent participation. For people who want both risk and an investment exposure, I think the unit-linked insurance plan will still be an extremely good opportunity to look at. And especially, Nikunj, you need to realize that the nature of liabilities in insurance is long-term. And therefore, people who are, for example, buying insurance for the next 30 years, for them, I think insurance is one of the best places to be in, because you can, clearly get into equity and stay invested in equity in 30 years, not try to time the market, and allow equity to work for you over the longer term. And as I keep telling people, insurance is truly a systematic investment plan, because you are paying regular premiums year after year, and you actually can take advantage of, rupee cost averaging, especially in times like this when markets, fall off the cliff.
But broadly, is it time to increase exposure to equities? Would you like to send that message across to your unit holders?
I would like to send this message across that equities is, for long-term investors, especially young policy holders who intend to stay invested for 30 years, they should have a reasonably large exposure to equities through the ULIP route. For investors who, obviously from an asset allocation perspective, need to have higher exposure to debt, because you have to realize that there are people who are older, who are who are reaching maturity, closer to maturity. For them to reduce risk, they must also look at moving part of their money into the debt markets. And believe me, the debt markets are not a bad place to be in at this point of time, because our own liquid funds, for example, last year yielded returns in the region of 8.5% to 9%. The bond funds itself yielded returns in the region of around 8%. So the yields that we've got on the debt funds have been extremely good. And at this point of time, obviously, we've been managing them with slightly lower duration, because the short end of the money market has been, giving extremely good risk-adjusted returns. But I think if the fiscal deficit sets itself right, if we get over the liquidity issues that are there in the market, I would see as we get closer to the end of 2012-13 in terms of the financial year, interest rates could actually start moving down, which would give debt investors, that added capital gain. I'm
not going to nail you down to a number, but broadly speaking, in next 24 months, do you think equities can give a 20 to 25% return?
I would not like to give you
just
a number, but if I look at the returns, the rolling 10-year returns that investors in Indian equity have given, it ranges between 15 to 18%. So if you actually go back to 1990 and you do a rolling 10-year return year after year, and somebody investing in 1990 and exiting in 2000 and so on, the average returns have been in the region of 15 to 18%. I don't see any reason why long-term investors won't get that kind of return from Indian equity.
What drives market in the short term is sentiment. In the medium term, to a large extent, it is liquidity. Long term, it is always earnings. Let's address earnings. Do you worry the course earnings have taken, or do you worry the course Q4 earnings have taken? Because the missing component for Q4 earnings was revenue growth, and the visible problem is squeeze in margins.
Agree with you over there. I think consensus expectations on revenue growth was not for Q4 but for the full year was something like 18-20%. Maybe we have fallen short of that. There has been a squeeze in margins, so profitability has at a net profit level also there has been some impact. But if you look at going into next year, I think expecting earnings growth of 14-15% is not something I would be be very worried about. And therefore, you may have a couple of years where top line growth and
have earnings hit the bottom.
Well, I would think so. I would think so because, we will have a lot of relief as we get into next year because commodity prices will come off quite significantly, oil prices will come off quite significantly. Interest rates, hopefully, by the end of this year will start reducing, and that will help us, help companies sort of improve margins as we go ahead.
I'm going to ask you a direct question. Your discretion, how do you want to answer this one? What is your big call for FY13? For
long-term investors, especially insurance investors, I think this is a good time for them to get into equities because from a valuation perspective, I think there is tremendous opportunity. And just to add, we have actually launched a value and momentum fund at this point of time with one of our new products. And the value and momentum fund is fundamentally focusing on stocks that have got deep value in terms of price to book, high dividend yields, right, significant cash on their balance sheet and other such parameters. And we do believe that we will be able to capture fairly deep value at this point of time, and investors who are there for 10-15 years will sort of.
And what's your big portfolio call for FY13?
As I told you, our exposures are to dollar proxies, our exposures are to the Indian consumption story, and we've got some exposure to the mortgage.
So OMC is one call where you are leaning on one side, and the rest of the industry is leaning on the other side.
But that's purely from a valuation perspective. Right.
And have you moved your investments from Bajaj to Birla now?
Yeah. Right.
Good to have you on the show. Thank you for your time. That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.